Well, it doesn't look like NVIDIA cheered anybody up here with these results. Small surprises out on EPS and on revenue. In fact, the smallest since the third quarter of 2022. And the market seemingly going back to the previously scheduled programming set for us last week. We've been talking all week about the growing recession scare. This is macro money. I'm Ilya Spivak, head of global macro here at tastylive. We got those scary-looking U.S. PMI numbers on Friday, suggesting that the last pillar of global growth is coming undone. And we've been going through it methodically this week. On Monday, we talked about why those numbers were so scary, what they meant, and why this is a global recession scare. We talked yesterday about why China, the world's second largest economy, is not in a position to be an offsetting force for that kind of a scare. And today, we're going to finish out with the third largest engine of global growth. And that, of course, is the Eurozone, and see if maybe we can get some help from the currency block here with the emerging growth situation, or if, in fact, we are looking at an environment where the giving out of the U.S. service sector and thereby the overall U.S. economy, the slowdown there, really does put us on a smooth and perhaps at this point irreversible glide path towards some sort of a global downturn. And we'll start the conversation with a look at the euro, because currency markets in their infinite liquidity and wisdom here are very telling indeed of what is going on. So we can see here the euro has been drifting a bit higher here since the beginning of the year. We put in that low just around the 102 figure as we started the year. And since then, the euro has been attempting to carve out something of a bottom. Now, obviously, the first thought is, well, something positive must be happening in the euro area for this to be happening. And so maybe capital is flowing to those markets. Maybe something is occurring to buoy investors' optimism. And indeed, when we look at the driving catalysts for the euro, we can see it is very much a creature of the short-term yield spread between benchmark Germany, the sort of stand-in for Eurozone borrowing costs, the largest economy in the region, and the U.S. And we're looking at the two-year spread here because, of course, that is the proxy for the front end of the curve, the relative sort of measure of strength and weakness between what the ECB is going to do relative to the Fed. We can see here that as we were heading into the second half of last year, the dollar was strengthening against the euro. That's what you see right here. Euro going down against the dollar. And that was happening against the backdrop of the U.S. and Germany spread going down. So, in other words, the euro looked like it was losing a measure of yield advantage here. And when we consider this in context, it would make sense, of course, that if this is the relationship that holds, the euro would weaken. And we can see that going into the new year now, some stabilizing in this spread has occurred. And so likewise, the euro has found a bottom. So that kind of rhymes with the idea that perhaps whatever deterioration was occurring might have at the very least stopped, if not necessarily improved. So what's going on here? Are we in fact seeing some green shoots in Europe? If we look at rate expectations baked into futures markets across the major central banks for the end of this year, we can see that apart from Japan, which is kind of this perennially low-yielding environment and has been for decades now, the ECB is seen having the lowest year-end rates of the major central bank bunch. And the U.S. is narrowly near the top. The Bank of England is very close by here, but the U.S. is near the top of the ledger, and clearly there's a big gap here. Europe expected to end the year with rates narrowly below 2%. Let's round it up to 2. Let's round up the U.S. to about 4. It's narrowly under that. That should be about a push. And so there's a 2% yield gap here, give or take, in favor of the dollar. So why has this stopped moving, and why is the euro finding support in it? Well, as ever, the markets don't care about absolutes. They care about the direction of travel, and the question that they're constantly asking is, what have you done for me lately? So they care about where things are going and how those expectations then line up with reality as it occurs. This is the direction of travel. So notice now the Bank of Japan jumps to the top of the list from the bottom, because despite having the lowest rates, it is also the only central bank looking to hike this year. We can see that they're on course to add about 50 basis points, somewhere in the middle here, between 0 and 1%, let's call it. And the U.S. is the least dovish of the cutters. So we can see here the U.S. on pace to cut about 50 basis points this year, in line, by the way, with what Fed policy prognostications told us back when the Fed updated their summary of economic projections in December. Markets basically lined up with that world view at this point. But what we've very interestingly watched here over the recent days has been a kind of rethink all around on just how much easing is in fact coming across the board. So if you look at this U.S. Curve here, what you find is that in the very recent days, it's kind of started to edge lower. And that lines up with the markets now pricing in 56 basis points in rate cuts for the Fed. That's the most dovish that market pricing has been for this year since the middle of December. Notice also that for 2026, which unfortunately we don't have on this chart, we have an increasingly dovish view as well, which lines up with this adjustment. That's a little bit different from what we'd seen before, where you'd get a little bit more hawkish in 2025's outlook. So there was a little bit of give back with a little bit more dovishness the following year. If the following year got a little bit more hawkish, then you'd get a little bit more dovish for 2025. The markets were essentially in this sort of back and forth fine-tuning mode. And what we've seen really since about the middle of this month, in the wake, of course, of this worrying growth data that we've seen out of the U.S., is a more concerted dovish repricing across the entire cycle here through the end of 2026. Now the markets are fully baked in for 27 basis points next year. That's the most dovish that they've been for that outlook going back really since these contracts in the Fed funds futures market had any liquidity in it. The last sort of comparable levels were about 26 basis points, again, back in December, about the first half of December of last year. So we're looking at the markets becoming increasingly more dovish for the Fed. Meanwhile, we can see the situation for the European Central Bank has actually cautiously moved the other way. There's not really a whole lot of movement, but we're certainly not getting any more dovish here as we start the year. And if we look at sort of the overall thrust of what's going on, we can see we're currently baked in for essentially no change next year from the ECB. This year expected to bring 85 basis points in cuts. Consider that basically 3 cuts with about a 50-50 chance of a fourth one, and the picture relatively stable. So we've been in this range here largely for some months, and we can really see it in the direction of travel of the yield curve. So from December of last year to the ECB policy meeting on January 30th, now into today's price action, we can see these yield curves haven't really shifted much at all. And so what you end up with then is a situation where the U.S. outlook, especially in recent days, is getting less hawkish, is shifting toward more easing, whereas the situation in Europe is standing still. And what that seems to be doing is accounting for how you end up with a smaller dollar yield advantage and the beginnings of a euro rebound. This does not appear to be a story of positivity about what's going on with Eurozone growth. Rather, it seems to be a story about deteriorating expectations for U.S. growth and a more dovish outlook for the Fed, and no counterweight on the other side, which of course gives us the results that we're now watching. Now, the next major inflection point from the European side in this story is going to be next week's release of Eurozone CPI. And interestingly enough, it's expected to go higher from 2.4 to 2.5% year on year on the headline reading. And the internals of this really start to stick out. Now, consider it's a fairly even spread here for the various components of CPI as far as the contributions. But when you look at the December breakdown, and of course, these will be January figures that come out next week, the one that really jumps out is this hospitality component. So about half of a percentage point in this overall 2.4% inflation number that we got in December was restaurants and hotels. Now, of course, we've had a little bit of a pickup from fuel. We can see month on month that's grown in terms of its contribution. The miscellaneous component here is primarily insurance and primarily having to do with autos and energy. We can see there's been a wiggle higher in the transport side that sort of matches that whole story. So it does seem like there's been a little bit more concern around the pricing of energy and everything related, and that's been bidding up costs a little bit. Of course, crude oil has become something that's rebalancing here. We can see down here you had the transport side of things and the energy side of things going from negative contribution to rebalancing to slightly positive, the transport side being negative and then slowly adjusting the other way. This miscellaneous component that includes insurance, that's been negative and now adjusting the other way. So some of what's going on here is just statistical rebasing as you sort of round the horn on year calculations. This restaurants and hotels hospitality component, which you see here in the purple, it's been remarkably stable and refusing to go down, refusing to let go of this baked-in inflation, despite an economic picture that looks, frankly, anemic. We saw the latest February PMI numbers for the Eurozone last Friday, as we did with the U.S. We can see manufacturing still very much in contraction mode. If you're unfamiliar with these numbers, though we talk about them on the show ad nauseum, they are centered around 50, where that's neutral, neither expansion nor contraction for the relevant sector. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So you can see that going all the way back to basically the middle of 2022, Eurozone manufacturing has been in various modes of contraction, a little bit faster, a little bit slower, depending on when you look. But basically, since the beginning of last year, it's been shrinking at a reasonably steady rate. You can see there's something of a range that's emerged here. But as with the US, it's the service sector that's the outsized part of the economy. And so you can see the composite numbers that follow both manufacturing and services really echo what services are doing, and essentially ignoring for the most part what manufacturing is doing, because services are a much bigger part of most developed economies than is manufacturing. And that's certainly the case for the Eurozone, despite some big manufacturing powerhouses in the region, like, of course, its largest economy, Germany. So what you're looking at here then is a second consecutive month now in February that we've held a thin hair above neutral. So 50.2 here is basically an economy at standstill. And it's been close to standstill now, going all the way back to basically the middle of last year. As the attempt from the shallow recession in 2023 to stage any kind of rebound basically falters by the end of the first quarter of last year, things fizzle back. You get a little baby contraction into the fourth quarter of 2024, and now you've basically come back to neutral, no growth at all. Moreover, if you look at what's going on with inflation expectations, they've actually trended a bit higher since the middle of last year. This is the break-even rate for Germany's short-term bonds. Break-even rates are just the difference between analog maturities in real, that is inflation-adjusted bonds, and nominal bonds. When you take that difference between those yields, you end up with the expected inflation that would take you from nominal to real. Right? Nominal minus expected inflation is, of course, what real is. So this extracts that inflation adjustment component. You can see that, of course, more recently you've had a little bit of a downswing, but the trend has been toward rising inflation expectations. And it's difficult to surmise that it's anything other than this sticky component right here, which will not go away despite the anemic economy, which you might think would give you an unraveling of discretionary spending on things like restaurants and hotels. So put it all together and you start to understand why, despite this weakness, you still have inflation that's expected to tick a little bit higher, and policy expectations that, despite that deterioration in the growth structure, hasn't gone anywhere. Surely the ECB doesn't find itself with any more room to cut when inflation is going in the wrong direction, and when the reason it's going in the wrong direction is stickiness in a part of the inflation structure that really should be unraveling but isn't. And so as we consider what this means in context, we of course come back to these results that we're looking at as of Friday. We can see from about the middle of last year a very strong US and cooling performance in the Eurozone and in China. And there's an asterisk here on the China numbers, of course, because those come out next week. But we learned in our conversation yesterday that the situation in China remains anemic, and we'll link that video here. If you're watching on YouTube, it should appear somewhere above my head here, this link. But just look at yesterday's macro money show, and we unpack it in detail. So the situation seemingly still lining up with exactly what you might expect. An anemic Europe, but with no room for the ECB to do much about it as inflation remains sticky. An anemic China, which recorded the seventh consecutive quarter of economy-wide deflation, and where the recent rally in Hong Kong seems to less so reflect optimism in China's economy coming back, and more so investors having found a way to take money offshore and done that through buying stocks in Hong Kong in part. So no real scope for a big recovery there, at least for now. And the big difference maker, and the thing that likely tips you into a global recession kind of conversation, this rapid unwinding of the U.S. and the service sector as the driving force of that unwinding. Just to remind ourselves here why all of this comes together, these three make up 58% of global GDP growth. The remaining 42% are mainly vendors to the larger three. So think Central Europe, Nordic Europe for the Eurozone, think commodity producers in Latin America and Africa and Asia, and of course Australia and New Zealand for China, think Canada, Mexico for the US as kind of the immediate dependencies. And so what you increasingly start to see is, if this leg gives way, if the U.S. part of this gives way, as it now appears to be, there is no safety net. And despite what we might be seeing from the euro, despite what these shifts in relative yield seem to imply at surface level, you don't have a positive growth story in the Eurozone, nor a dovish central bank story to offset it. And if what we're seeing in the U.S. is going to be lasting and a larger decline than just a 2-month run, well, then it becomes difficult to see how you don't end up in a global recession at some point this year. And that is Macro Money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what might follow. I'm on with Chris Mondays and Fridays for Futures Power Hour, on with Victor Jones for the Price of Truth on Tuesdays, back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter, as well as on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money's back tomorrow.